Hi, I'm Garrett Cayet, SFMG's Chief Investment Officer. I want to provide a brief market update as we head into the final few months of the year. So the third quarter got off to a strong start with the passage of the One Big Beautiful Bill Act, which increased economic stimulus in a few ways, including making the 2017 tax cuts permanent, reintroducing accelerated depreciation, and committing billions in spending to domestic industries. There were also a number of trade agreements announced with the EU, Japan, and South Korea, plus a US-China trade truce extension, all of which helped reduce the market's anxiety around trade. Eventually, focus shifted to the labor market and Fed policy. The July jobs report came in much weaker than expected, showing slowing job growth as well as sizable downward revisions to the previous month's reports. So the labor market was showing signs of softening, but it also boosted expectations for Fed rate cuts, which helped offset some of the economic concerns and ultimately kept stocks trending higher. And then after another disappointing jobs report in September, the S&P 500 continued to climb higher. The Fed eventually did deliver on that first rate cut, and strong artificial intelligence related earnings from a few companies like Oracle and Broadcom reinforce the artificial intelligence driven market momentum. So as we get into the fourth quarter, the macroeconomic setup is still positive, but we're continuing to monitor a number of risks out there. First, the labor market is showing signs of deterioration. And if unemployment continues to rise, investors may be caught off guard as recession risks do begin to eventually outweigh the optimism around Fed rate cuts. Next, inflation has remained sticky at around 3%, which is above the Fed's 2% target. So if tariffs or any other macro forces create additional upward price pressures, it could potentially force the Fed to pause their rate cutting cycle, which is not an outcome that markets are currently pricing in. And lastly, the S&P 500's valuation remains historically elevated and largely driven by the artificial intelligence narrative. If tech spending around this singular theme begins to slow, or AI adoption disappoints in any way, the substantial profit growth that is already baked into these major tech stocks could unwind very quickly. So while steady growth and easing Fed policies support a constructive outlook, we're mindful that markets appear priced to near perfection, and we want to maintain a strong balance between opportunity and caution, while also being careful to not chase any of the short-term momentum that we're seeing heading into year-end. Thank you for listening, and if you have any questions about your portfolio, please feel free to reach out to your SFMG team. Thank you.